Okay, so our next guest here is Nishikawa. Some of you have seen him. He's been in our office pretty much every year for the past several years, right? We're very lucky to have him. He does drive down here from
San Diego.
San Diego, yes. So you guys are very special. Anyway, he grew up in Southern California, attended Point Loma Nazarene University, Romanian School of Business. Upon graduating, he obtained his real estate license, began a career in commercial real estate in Orange County. He quickly became fascinated by the implementation of a tax-deferred exchange strategy within an investment portfolio. Moved to San Diego, joined ERI with the intent to help clients build toward a better future. He enjoys playing outdoor sports and spending quality times with friends and family. Let's make him feel welcome, Nishikawa.
All right.
Okay.
All right. Thank you so much.
And feel free to stand over there so people can see you.
Perfect. Now that we're being recorded, I have to change what I have to say. Just kidding. I'm really excited to be here today to really talk about the 1031 exchange. I really want to simplify it for you guys, hopefully make it easy. On your desk, you have a copy of a one-page exchange guide, which is handy. Those are just the nuts and bolts all on one page, try to make it simple for clients, as well as an escrow expense worksheet, which we'll kind of explain later. I do, yes. And I can also send this via PDF to be distributed for everyone that's not in attendance today, to make it easier.
Thank you.
Perfect. So this is a great topic. A little bit about the 1031 exchange market right now. We're down about 52% when I looked from Q1 2022 to Q1 2023. This is obviously across the market, down transaction numbers. So that's kind of where we're sitting for the 1031 exchange as well. We've been doing 1031 exchanges since 1999. So our company is attorney owned and we've pretty much seen it all. We do a little over 3,000 exchanges every year. And our goal is just to be the complete experts when it comes to delayed exchanges, reverse exchanges, build suit construction exchanges, everything in between. So I always like to start with a definition of what is a 1031 exchange. A lot of you already are very familiar with this, but I do want to go over it just in case anyone is a little newer. The 1031 exchange is part of the tax code. It is not a loophole. It is actually from section 1031 of the tax code. And it's a transaction which allows an investor to defer the payment of capital gains tax as long as they exchange into like-kind investment property of equal or greater value. So unpacking that definition, this is for investment properties only. Investment properties, I like to think all real estate is an investment, but investment properties to the IRS are filed as such on their tax return. So somebody comes to you and they're not sure if this is an investment property, well, it's going to be dependent upon their CPA. So just like you, I don't want tax liability for giving tax advice, so I send them to their CPA. Second underlined word, deferred. The 1031 is a deferral program. It is not tax-free. So your clients that sell their primary residences get that 121 exclusion, which is tax-free. This is going to be a tax-deferred program. So that means that they're kicking the can down the road. They get to use the equity in the meantime to purchase their replacement properties. And they basically get to keep that money working hard for them instead of paying that to the government. So that's a big plus. Like kind. So like kind, I get this question a lot. A lot of clients call me, they have a condo. They want to buy something other than a condo. And they think that like kind means they have to go buy another condo. Fortunately, like kind, super broad term. It's the qualified use of the investment of the property for investment or business use. So that means if you have a dentist, he owns his own dentist office. He sells his business, decides he's also going to sell the real estate, that would qualify. It was used personally, but for investment or productive use in a business. That counts for triplexes, fourplexes, condos. There's really no limit. As long as it's real property, it's exchangeable. So the 1031 exchange is pretty broad as far as what it applies to. So why, now that we've kind of gone over what is a 1031 exchange, why are people doing 1031 exchanges? Why would your client do a 1031 exchange? So the first part is obviously tax deferral. This is the biggest part. When you're looking at, I'll just switch to the next slide and come back to this one. When you're looking at potential tax liability for an investment property, it's very different than what you'd be facing for a primary residence. So you would obviously have them consult their CPA. Their CPA is going to break down these numbers for them. The first part is long-term federal capital gain tax. This is going to be up to 20%. It's going to depend on their income bracket. So it's really going to range, but most of our investors are between 15 and 20%. You're going to have the affordable healthcare surcharge tax, which is 3.8%. That's a Medicare surcharge tax. That's for any investment over 250,000. So they would also fall into that for stocks and other things, but it does apply to the 10th or to investment real estate. Third is depreciation recapture. So depreciation recapture, most residential investment property has a maximum depreciation schedule of 27.5 years. So if your client comes to you and they've owned this property for 20 years, they are going to pay a 25% depreciation recapture tax on the benefit that they've taken over the last 20 years. So that's kind of like a back tax. And then there's going to be the state capital gain tax. I have a chart of all the states. California is the highest. I know everyone's really shocked. 13.3%. Yeah, we're number one for the highest state capital gain tax. So it's a lot, this is when number one is not good. So these taxes add up typically between 28 and 34% of their capital gain and tax liability. That's a lot of money. It's the easiest selling point for me. I say, go talk to your CPA. Everyone thinks it's a flat 20%. You've probably heard that as well. And they go to their CPA and they're like, oh my, they can't believe it. And it's like, oh yeah, so it's really hard sales process for me. I'm like, well, you can pay this or you can do a 1031 exchange. And usually they choose the 1031 exchange. So back to reasons for doing a 1031 exchange. Besides the tax hit, there's portfolio diversification. I always say this in my seminar. I have a lot of investors that during COVID were not receiving rent from their tenants. And that was obviously very bad, especially if that was their only income source. So sometimes it's nice to diversify, have multiple investment properties so that if one of them stops paying you rent, you're not losing 100% of your income. Cash flow improvement. We all know some of our landlord friends are a little too friendly when it comes to raising rent and bless their hearts for giving back, but a lot of times cash flow improvement can be fixed. It's usually very under market. I have a lot of situations where tenants been in there for 10, 15 years and they've never raised rent. So it's one of those things where that's an immediate benefit for their side. Estate planning, 1031 exchange is a great tool for estate planning. I have a lot of clients that call me, they're like, well, I'm thinking of gifting this property to my son or gifting my property to somebody. Now they don't understand that when they gift a property, that they don't get any of the estate planning benefits. They're giving the property with that tax liability attached to it. So if their son receives this property and sells it in the next year or whenever, they will have to pay that capital gain tax. Whereas the 1031 exchange, the saying in our business is, defer, 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 die, because your heirs will get a step up in basis, meaning they won't pay any of those accumulated capital gains taxes. So yeah, it's not the most positive slogan, but I don't write it down anywhere. But it's nice. You get to leave something to your kids without them having the liability attached to it, because that would be a large tax bill to have to pay upon inheriting. So proximity, that's the other one. I have a lot of investors, they move to Palm Springs and they want their investment property to follow them. They're in San Diego, but they don't want to drive back and forth. They love to self-manage and they just want to have it out here. So it's definitely something that proximity is a reason as well that people do the 1031 exchange. So these are just a few of the obvious reasons. There's a million other situations, but yeah. And hopefully everyone has a copy of this. So some examples of replacement property: land, single family home, multifamily, commercial property, air rights, oil and gas rights, Delaware statutory trust. Oil and gas rights investors have been making a killing, obviously, recently. Delaware statutory trust. So these are all just some examples of like kind real property. Any questions on this? Yeah. Yeah, just make sure previously, 2 years previous of investment property status on their tax returns. And then when they do the 1031 exchange on the purchase, they need to make sure it remains an investment property for 24 months before they change the status. Like people call us all the time and they're like, well, what happens if I have to move into the property? Well, unless there's extenuating circumstances, they would have to wait 2 years minimum. So.
And do you see like the investors who usually put the property in an LLC or some sort of corporation?
Everyone owns their investment property in a different way, whether that's a trust, single member LLC, or tenants in common. There's no requirement, but you do have to remember, and I'll get to that point in a second after this slide, you want to make sure that how they sell the property is how they buy the property. So if they have the property in their name, they want to buy in their name, etc. Because the tax ID number has to match. So the IRS tracks our taxes through our tax ID number. That's an easy flag for an audit. They see the tax ID number doesn't match, red flag, boom, audit. So that's one thing you want to keep consistent.
So how you mentioned earlier, like if we were to leave a property like this to a loved one, it's easier to have it in a 1031 exchange if there's more tax benefits to the heirs or whoever's gonna inherit the property.
Right. I wouldn't gift it directly to them. I would just have it as part of my estate plan to leave the property to them. So yeah, good questions. What does not qualify? So personal property, stocks, direct ownership in a real estate investment trust does not qualify. It's paper money. And then primary residence, of course, does not qualify. Getting to your title holding question. So like I just said, we are just a number to the IRS. They want to see a matching tax ID number. So if it's in your individual name, right, it's filed with your tax ID number personally, you want to make sure you're buying with your personal tax ID number. Now you could put it in a single member LLC, as long as that's a disregarded entity that's still filed on your personal tax return. So they don't care if you put it in that. But if you put it in a single member LLC and it's not a disregarded entity and you choose to elect to file this as a corporation, then that's completely different. That tax ID number becomes the owner, and you cannot just switch from your individual name into a company's name and vice versa. If you do plan on doing that, you just put a little time between it. Some of our clients, they wait 13, 24 months before they do an exchange if it's going to be in a company or they want to put it in a different name. So any changes to title, do it the earlier the better. So plan in advance. Multi-member LLCs are tricky because it's all a bunch of investors that own this corporation, and the corporation owns the underlying assets. That corporation has to keep going through the 1031 exchange. They can't just dissolve the corporation and then do a 1031 exchange because it won't meet the 24-month threshold for holding the property as an investment. Whenever you dissolve a multi-member LLC, the government sees that as a change of ownership. So you want to make sure you're waiting the 24 months. Or just buy as a multi-member LLC and dissolve it later if they can't wait, right? Tenants in common, I love tenants in common. This is the easiest way if you have a business partner to do an exchange because you get to take your percentage ownership and go your separate ways. It's great. This also goes for, I did a consult this morning on the way here. A couple was getting divorced. She wanted to know, well, what happens? This couple owns this investment property. Typically in a divorce, they're going to sever the property out of joint tenancy into tenants in common, and then the divorced couple can go their separate ways to a 1031 exchange. They won't have the same 24-month requirement just because it's a change of circumstances, extenuating circumstances. So even if they've been filing jointly for the previous 2 years, they can do that. So there's a lot of things when it comes to holding title. Happy to consult on that. It's a quick text or phone call to me, and I can help you figure it out. We do have attorneys on staff as well to review any trust documents, revocable trust, irrevocable trust, et cetera. Yeah. Any questions about holding title in a 1031 exchange? Yeah.
The part where they get divorced and what happens after that? 1031, that they go separate ways.
Yeah, they'll sever their joint tenancy and then they'll go into tenants in common. It's usually just a quick deeding. And then they can, when they do their sale eventually, they'll take their 50% each.
Oh, 50%.
Right. And they can go do separate exchanges. They can, a lot of them don't want to be exchanging together. So they're going to. Yeah. Yeah, at the close of escrow, we will create 2 accounts, stolen separate for each of them, and they will do their own exchange. So everything will be separate.
It's just half.
It's just half, unless the court deems otherwise for whatever reason. You know, if they had another asset that they kept and they wanted to have less of this asset, but you know what I mean? Like they're going to take their percentage, whatever they agreed. Correct. Exactly. Or they could elect to pay taxes. I had a month and a half ago, one of my couples, one of them wanted to just pay the taxes, the other one wanted to do a 1031 exchange. So they can elect to do that as well. So it's all situational, right? Life is situational. Replacing debt in a 1031 exchange. So when you look at this valuation, you got $1 million sale, you're looking to do a 1031 exchange. The loan payoff amount at the close of escrow, let's just say for this example, is $300,000. When you do a 1031 exchange, you have to get a new loan of equal or greater value on the purchase. If you don't, you will pay taxes on that as capital gain. So you want to make sure that you get a new loan of equal or greater value. The biggest thing is clients call me and they got 700 grand. They're like, I'm just going to go buy something for 700,000. And I'm like, well, hold up. You will pay a big tax. You can do that, but you will pay partial taxes on that remaining $300,000 mortgage boot. So it's important that they understand that they must replace the debt. Now they can do that. Let's just say they're going from 1 property to 2 properties. They could put the 300K, do 150,000 on each property. They could do all cash for 1 property with a mortgage on the other property. It doesn't matter how they split it up, as long as they have it on their replacement properties somewhere. So
And it has to equal $1 million, not 700.
right, yeah, if they're $1 million sale after closing costs and everything, that's what their target is exactly for full tax deferral.
And they don't keep the same interest rate, I guess.
Pardon?
They don't keep the same interest.
No, they do not.
Still gonna get,
All
they're
right.
gonna split something out of it.
Likely for prorated taxes, lender points, all that is paid out of pocket. The closing cost, though, identified on that sheet, I guess a good time to go over this. That kind of tells you what can be paid from exchange funds. So that first top, those are exchange expenses. You can pay that from the holding account that we are holding. Everything underneath that cannot be paid from your exchange funds. So it might take some funds out of pocket, but fortunately your commissions are deductible on there, as well as escrow, title, the typical non-recurring closing costs. You just can't prorate rents or do anything like that. And I'll go over this in a little more detail at the very end. Any other questions about replacing debt or perfect. It's always nice to have a lender speak before me because they're like, oh, you're thinking about like, what am I going to do? So you have a few different 1031 exchange options. The first is the delayed exchange. This is 95% of our 1031 exchange transactions. It's the planning and consulting stage. That means they're talking to you. They're talking to me. They're talking to their CPA. They're figuring out this is what they want to do. You're going to list the property for them and put it on the market with, of course, the typical language of buyer to cooperate with seller's 1031 exchange, blah, blah, blah. And then at the close of escrow is going to be the beginning of this time frame. So this time frame does not begin until escrow closes. So if you need more time, you're going to put some extensions in there. We have a lot of agents that put in a 15-day, 2 15-day extensions, as long as they think the buyer is willing to cooperate. That gives their client a little more time to search and find that perfect replacement property. At the close of escrow, they will have 45 days to identify potential replacements. We're going to send you a form, and they're going to fill out that form with 1, 2, 3 properties that they plan on buying through their 1031 exchange. They must return that form to us by midnight of the 45th day. If I get it on the 46th day, I do not backdate docs. That's a failed exchange. So it has to be in by midnight of the 45th day. It is important to understand there's 2 options for identifying. The first is the 3 property rule. This is used by most of our investors. They can list up to 3 properties. They just have to buy 1 or all of those properties by the 180th day. The other option is the 200% rule. If they want to identify 200% of their sale price, that's the alternative. So let's just say they sell for $1 million and they identify 4 properties, $500,000 each. That's okay. They're under the 200% of their sale price. So $1 million, 200%, $2 million. So 4 properties, $500,000 each, they can identify that. So that's kind of the 2 options. Our clients typically use the 3 property rule, but I've got some aggressive investors and they want to do the 200% rule. So I'll leave it up to them. They understand the risks.
So when it fails, oh, I just.
So when they go beyond the 45, and let's say they went to 46 or fulfill 1031, what happens then? What is the?
Right. So there's two things that happen. One, if they already identified the property, then we have to hold on to the funds till the 180th day. Let's just say they couldn't buy anything on that list. And even if somebody else bought them, the IRS wrongly assumes that they could offer to buy it from the person that just bought it. Not realistic, it's not going to happen, but that's why they make us hold the funds, because it's still a exchange in progress technically. If they don't identify anything, then on the 46th day, we will return all the funds. So there's no extra penalty. They gave it a shot, but they would have to pay taxes. We will, of course, just like escrow, withhold 3 1/3% for California Franchise Tax Board.
So there's no extensions on a 45 day.
We're currently in the midst of an extension. Typically, no. So the disaster that California went through, that we were all suffering through, is an extension until October 16th. So exchanges that happened between December and February, whatever, some of them are extended all the way. They moved the 45 day and the 180 day to October 16th. Never seen this before. You know, yeah, it's so unique. So we've been kind of fielding the questions. It's all situational. So we leave it up to their CPA to see if they qualify. I have investors that opened escrow last month and they're still using it. So it's up to them what they want to do. We just want you to have a defendable position with the IRS, whatever that means when it comes to qualifications. But typically, no extensions. So
But the 180 can be extended 15 and 15, so 30 more days.
yeah, this time frame cannot be extended as a time frame, but the close of escrow you can extend when you sell, because this time frame does not begin until you close escrow on your sale property. Correct.
15 days or all of it. So you get it
Exactly.
on-
On the sale side, yeah. Which of course, during this whole bidding war situation the last couple of years, we had a lot of clients doing that because it was so hard. You have 45 days to find something. It's still really hard. There's not a whole lot on the market. It's challenging. So it's good to have that extension. Maybe they lock their replacement in an escrow as soon as possible. We have some clients that run concurrent escrows. I'm doing one right now for, I think she's in this office, Suzanne Schroeder. Okay, yeah. So it's a concurrent closing. So their sale and purchase is closing on the same day, and that's allowed. So you can do that. So that's guaranteed as long as they close on time, right? You need that sale to close at least one day or on the same day as the purchase. So you want it to be either before or the same day. One day later, and then we have to go into a whole different type of exchange, which we probably would not have had set up at that time. So you want to make sure you can do it. And then of course you have until the 180th day to close, but the 45 days is really the part that is crucial.
What was the 200% rule?
Yeah, so if you sell for $1 million and you want to identify more than 3 properties, they just cannot add up to more than 200% of your sale price. Right. So as long as it's under 200%, because we have some clients that come out of Palm Springs and they go to like Indianapolis, and you can still buy a house in Indianapolis for like $80,000. So they have to buy a lot of properties, right? Especially if it was a big investment. So they're like putting down all these addresses, and it always makes me double take. So I'm like, what? And then I'm like, it's not in California. Yeah, like, what is this? All right, so next, that brings me to the point of the reverse exchange. If you decide you want to close escrow on the purchase before you have time to get your sale completed, we have to structure a reverse exchange. This is a great option if your clients are very averse to the 45-day window and they want to guarantee they get the perfect replacement property. So this time frame does not begin until you close escrow on your purchase. After you close escrow on your purchase, you have 45 days to identify which property in your portfolio you plan on selling, which most investors know, kind of already have that figured out. And then you will have to sell it for them by the 180th day. So that does put you on a time frame for the sale side. Yeah, you must close escrow on that sale by the 180th day, which is good. It's a clock on your commission, right? But it's definitely can be tight. So it just kind of depends on the property. I've had some tricky land deals where I was like, I don't know about 180 days on this deal, but That's the goal. So the reverse exchange is excellent if your clients are just not willing to risk not finding something in 45 days. So, yeah, it's more expensive. Our attorneys have to create a corporation just for this transaction. We have to park either the sale property or the purchase property in that corporation. That's just the Franchise Tax Board, and the IRS does not allow you to be on title to both properties simultaneously. So we will have to hold one of those in a corporation. So you can imagine from the lending side, the only big complication with this exchange is if your clients don't have the cash to make the purchase or are able to get a hard money loan, we cannot take title to a property. No lender will give them a loan for property we are on title to, right? Pretty typical. So that's the only caveat. They have to have the cash or the ability to close on the purchase. So, but they guarantee they get the property they want. So I don't know. It's about $8,000 to do a reverse exchange. So more expensive, but not as expensive as all their taxes. So just kind of depends on what they're feeling like. But our typical 1031 exchange is a flat fee of $1,250, one sale, one purchase. And if they have additional escrows, then we just charge $350 for the additional escrows. But yeah, that's regardless of the value of the property.
Wait, yeah. How much do you charge?
$1,250 for one sale and one purchase. And then it's plus $350 for each additional escrow. So if they buy multiple replacement properties. Yeah, perfect. We also have something called the build to suit construction exchange. Let me know if I'm doing okay on time. The build to suit construction exchange. This is something that we've been doing a little bit more of. So let's just say you have a client that sells a property all cash for $500,000 and they locate the perfect replacement property, but it's only $400,000. Well, they can use the balance, 100,000 give or take, to make improvements to their new property. So new roof, potentially do an ADU if permitting's quick enough, or a junior ADU or some sort of renovation, they could fix up the property. So that one also is $8,000 because we act as a fund control. We pay all the contractors out as the work is completed so that your clients never receive any of the cash because that would be the taxable event. And then that way, when we deed the property back to them, keep in mind, we also have to take title to this property as well, because they have to receive a fully improved property equivalent in value. So we have to hold it. When they get it back, it's worth the 500 target that they were looking for, or usually more. Usually it comes in a lot higher. So it's nice. I mean, it's as they make permitting easier. And if you have a good network of contractors, it's something that you can get done. So recently we've been doing a lot of ADU build outs with the 1031 exchange.
Sorry, there is one question with the lack of properties and the requirement to pick a property within a certain length of time. Is there any allowance if you don't find a property in that length of time?
Good question. No allowances. So unfortunately, you would have to locate something. Good question.
Is there a time frame?
We really need to do this so they can hear questions, guys.
Is there a time frame to spend the $100,000 between 400 and 500? Do they have to do it within a year, 2 years?
It's 180 days.
Oh, everything.
Mhm. All the money must be out of the account and paid to the contractors by the 180th day. So
6 months.
6 months, yeah, just shy. All right, what is boot? So any cash proceeds remaining after the acquisition will be taxed appropriately. So some of our clients, they want 20 or 30K because they want to travel, they want a new car, they want to pay off credit cards, whatever they want to do. They can do that. They'll pay prorated taxes. So if their CPA told them they owed 30%, they would pay 30% on whatever cash they receive. That would be considered cash boot. Mortgage boot is any debt that they do not replace on the purchase. So some of our clients don't want to have any debt and they have the cash to fill the void. That's okay. They can bring in cash from another source instead of getting a new loan. We have clients that do that. So it's up to them, but they do want to make sure that they get some new debt on the property if they don't have the cash, or else they'll have to pay taxes on that. How to calculate my net replacement value. So sale price minus closing costs equals your net replacement value. So that worksheet in front of you, all of those expenses on the top. After you deduct all of those, that will be their target replacement value for full tax deferral. So if they sell for $1 million, maybe they only have to find $950,000 of real estate. So it's kind of like Well, after you deduct all of those, that'll give you that accurate number. And then that's what they must go purchase, equal or greater. So this this question, I get this question a lot, and I've never added it into my slides. And then one of your agents, I think her name's Ellie Tourget, she's on vacation right now. She was like, she had a client that wanted to do this. So I was like, okay, so you know, everyone knows there's buyers and sellers credits and everything as part of a transaction. So this situation here at the bottom, so taxpayer needs to buy a property for $700,000. Well, let's just say the property they find is $600,000. They can't offer to pay $700,000 and get a buyer's credit for $100,000 towards closing, and that's not going to count for the 1031 exchange. So if anybody has that idea, unfortunately, the net purchase price is still going to be what the net purchase price is going to be. So they would still have to pay boot for that amount. And Form 8824, when they file taxes and everything, will reflect that number. So it's a funny situation, and I get asked it a lot, and I've just never put it in the slide. But I was like, well, it's kind of something funny and something that now you have the answer to if one of your investors thinks they can do that.
Can you negotiate the price for 1031 exchange? You can negotiate the price for the
You
buyer?
can. The question is, can you negotiate the price for the 1031 exchange? Of course, yeah. This does not change your ability to negotiate the price. This is just they were already agreed to sell the property for $600,000. Why would you pay $700,000 for that property just to try to get away with getting some sort of a credit on the back end? This is just them trying to game the system. But yes, absolutely negotiate with your 1031 exchange. 1031 exchanges are strong offers. They're on a time frame, and the seller knows that. They are usually not 3% down. Seller knows that. It's a lot of cash typically. So they're strong offers. And I just think that it's something that if I was a seller, I would be inclined, because I know this person's going to close escrow because they need to close escrow,
Yeah.
or they have to pay taxes. So it's kind of like, typically the sellers, they like that. What resources do we provide? So of course, seminars like this, I'm so thankful to come to this office. I try to come every year, but I also do seminars for investors. So let's just say one of you had a book of investors you wanted to invite to a lunch and learn. I'm happy to come out and speak at that and educate them. It may not be this long of a presentation, but I'll do the Cliff Notes version, make it feel really simple and effective for them, and focus more on the reasons to do it than the mechanics, since we will help them do the mechanics. We just want to give them the reason to sell their property. Marketing materials, I have some marketing materials if you're looking for something specific. Happy to help you create that. And yeah, the QR code, if you scan that, that's all my contact info. We'll put it in your phone in case you need to save it. And yeah, does anyone have any questions or any 1031 exchange? Yes.
You offer any classes for us?
Classes, like do I offer any classes for you?
Really, oh, we get certifying forms. Can we get certified in 31 or some kind of special idea kind of certification?
No, we offer CE credits for CPAs, but nothing for agents. Yeah.
Market it directly for it.
Well, you can market saying, you know, they're interested in 1031s.
That was, she was,
Call you.
I think she was more so looking for the certification.
Ah,
Oh,
right.
And if we don't get certified, can we still take the class?
Oh, absolutely. Yeah, I mean, I'm happy to also do a class on just going over the exchange contract and stuff like that
Yeah.
to help you get familiar with that. You know, that's definitely something I've thought about doing. And then, yeah, any marketing materials or consults. I do Zoom calls, in person, whatever you need, just let me know. Happy to help. Yes.
So every second home can be exchanged.
Can every second home be a 10? Can a 1031 exchange be for a second home? So that's a great question. So second homes typically do not qualify for 1031 exchange because they are not investment properties. But you could make a second home an investment property by not using it more than 14 days per year, or 10% of the time it's rented, and then having some rental income. So let's just say you put it on Airbnb. I have investors that out here that just put their property on Airbnb only during Coachella, and that's it. And so that once Coachella's over, they've made $40,000 for one weekend. And then they're like, okay. And that would potentially qualify. as long as they're not using it personally for more than 14 days or 10% of the time it's rented. So it's not a hard no, but they need to make sure they meet the qualifications. Great.
Hi, this is Jay on Zoom. I don't know if you can hear me.
Yes, Jane.
I was a little confused on your like-kind property. So like, I have a condo. So do they have to replace it with a condo, or can they place it with a single family? Or that was the confusing part on that one slide.
Yeah, good question. So the 1031 exchange, like kind, is just investment use of the property. So as long as their property is going to be used for investment use, it could be commercial, could be land, it could be a single family home. They could buy a triplex, a duplex, it doesn't matter. So they can exchange out of a condo into whatever type of real estate as long as it's investment.
Thank you.
Perfect.
Thank you, Jane.
Good question.
What other questions? A lot of information, isn't
It's
it?
good,
Yeah,
yeah.
it is that.
Can we email this, all this material? please?
Yeah,
Yes.
they have it all. So
And send the recording as well.
So you mentioned all the good, let me, my voice, you mentioned all the good things about 1031 exchange. What is the downside of 1031 exchange? Is there any down that would affect the transaction?
I would say.
The question is there any
inventory and the
downside
time
to
is
1031 exchange?
constraint.
yeah, I guess you're on a clock. So that's always a little more pressure for the investor. Typically, the failing points of a 1031 exchange occur within the 45-day window. If they don't find something, that's the end. So the 45-day window, so having them narrow down their search, really drilling in on their criteria will help you find them something quicker. Because some people, I get the call on the 40th day. What do you think of Texas? I'm like, oh my gosh, 5 days. I need the actual addresses. It's an eye roller. It's a good thing I'm on the phone. So I'm like, oh my gosh.
So will you see it's better, like, for example, if someone's in 6 months wants to do 1031, it's good for them to start looking around what area before they even get in a situation.
Yeah, I mean, it's
Okay.
Well,
it's
especially
better.
with the market, the way it is, and inventory being so low, they really do need to find some properties that they can think about before they move forward.
And that gives you the opportunity. If it's a community that never has something for sale, you might have to do mailers. I have a buyer looking to buy in this area, whatever. Yeah, exactly. If you really need to find them something, it's
Absolutely. Any other questions, Zoom or here?
Yeah, I had a quick question. Can you hear me?
Hi, Elaine. Yes.
Hi. Hey, quick question. What if you have an investment in California and you're 1031 exchanging into another state?
Exactly.
great question. So the 1031 exchange, being a federal part of the federal tax code, is national. So
Okay.
fun fact, a statistic from my company, at least, 30% of my transactions leave California. So yeah, they sell here and they're buying somewhere else. And there is one thing to be aware of. So California has a clawback provision, the lovely franchise tax board, they follow your property. So you sell from here, you buy in Texas. Well, when you eventually sell Texas, if you don't do another 1031 exchange, franchise tax board wants their prorated taxes back from when you were in California. So they follow you. And there's a few states that do that. And I have clients that go from California to Texas to Oregon to Utah. And a couple of those states will have clawbacks and they owe tax to like all the states, right? So it really depends. But as long as you defer until you die, then you don't pay any of those taxes.
Good for that.
Say defer until you die and then it goes to your kids. What do?
Pay the taxes.
Right, they either pay taxes or they get a
Until they die?
1031 until they die.
So it's as if they received the property brand new. So they could sell it the next day. They won't have any capital gains tax because they get the step up in basis to the appraisal on the date of death. So the property's $1 million when you pass away. They sell it for $1 million. There's no capital gain because the value is exactly what it was appraised for. Right. Now, if they keep holding it, we have clients that 5 years ago inherited a property. Unfortunately, that property went up 40% since they inherited it. So then they would have to do a 1031 exchange.
So it doesn't, but if a person dies today and the kids don't sell it for 5 years, it's.
They only They only owe the 5 years from that date of death.
So not from the time the adult bought it.
Exactly. So that's the huge benefit of doing it.
Huge.
Yeah,
So it is. $6,000 going in a 1031, they don't get taxed on it?
no, the gains die with the former owner, so,
So that
yeah, basically.
I'm so excited about it. Oh, it's super cool.
so in this hypothetical situation, 5 years. The kids had the property and then they sold it. Who determines what was the price 5 years ago? Is it the assessment board? Or someone?
Yeah, whenever it transfers, you'll usually have an assessment or appraisal of the property, and that would
Mhm.
establish what that property value would be.
Yeah, when somebody dies, guys, it's a good idea, and this is just for your
Right.
knowledge too. And whoever is up there, we need to put them on mute, but when somebody passes, there should be an appraisal of that property. Because I can't tell you the number of phone calls I get from people saying, hey, we're trying to evaluate my relative's property that died 2 years ago, but we need to find out what the property was worth on this day. And you
Right.
literally have to go back and look at comps from 2 years ago and it's very challenging to do. So it's best if somebody does pass, get an appraisal. So now you have an actual appraisal of what that property's worth when they died.
Wow.
Yeah.
Good tip.
It is
Yeah.
really important.
So,
Jay,
so is it the cons
it's
or
time
is
for
it-
appraisal.
or is it the? Your count assessment?
Well, they're really looking for comps or an appraisal. I mean, they'll look at the county, the appraiser, though, they're looking at everything, but really the question we get 100% of the time is, what was that property worth on the day of damage, right? And so that's what they're trying to find.
Yeah, you have to, it's all about intent. The 1031 exchange itself is intent. So the 24 months I was talking about, that's not in the tax code. 24 months is best practice. We have a ton of case law we review, and that's what we have established as. But we've have clients that do less than that and they're okay. So what we want to do is partner with your client's CPA and make sure that they have a defense position. And that's all that matters at the end of the day. Perfect. Well, thank you
Okay.
so much.
Thank you so much. Appreciate
So happy to be here.
Thank here. Okay, lots of good information. Couple of quick reminders. We've got about 5 minutes here that we'll go through a few more things. Just, there we go. Just a heads up, I'm finalizing right now our mentorship program. It should be ready to launch next week. If you are, we'll be talking, but everybody is invited to participate. But literally, if you're new or you just need some extra assistance, let's talk about it and we'll see what we need to do for you. But I'm really excited about it and I can't wait to see all of you reach new heights. Today, this afternoon, is our real estate roundtable masterminds. The topic is the pillars of lead generation. And so it is all about generating leads to your business. And so Mark is going to be moderating it. It's today between 2 and 4. Remember, I sent out the Google Meet. If you cannot be here live, of course, it's 100% much better to be here in person so we can exchange and share ideas. It's just the energy is better. But if you have to participate via Google Meets, you have to have your camera on and you have to be ready to talk and participate. Otherwise, don't even bother. So that is today. We have, of course, our luxury newsletters are out. So if you want to be sending out luxury newsletters instead of the standard newsletters, they are available on the National Resource Center. Check it out. And then Mason, hi.
Hi. Morning, guys. Just quick update. We do have our Tech Thursday. We're going to be reviewing YouTube and getting your guys' channels all set up and going. Then same thing what she was touching on. You guys do have the luxury newsletters available in the National Resource Center. So make sure you guys are utilizing those to its fullest because it's got some great content that's readily available to you. Other than that, let me know if you guys want to make an appointment and if you guys need any property flyers or anything for the weekend. I believe it's at 11:30.
Yeah.
11:30. It's about an hour long, I would say. It's about 12:30.
Of course, you're going to have a lot of questions and you're going to have so much fun.
Yeah.
uploading your videos and creating your channel and sharing them. You'll never want that. Okay, that's gonna be a lot of fun. So we also have launch starting May 1st, and we've got so much, there's so much for you to take advantage of. No excuses. We have eliminated every excuse in your book about why you may or may not be making money. So launch starts May 1st at 11. Look at all the topics that we have, and we are covering everything. So keep an eye out for all the emails and the links for that as well. Thursday, May 9th, if you plan to attend, this is Apple training. This is not real estate related, just so you know. We're getting an Apple certified trainer to come to the office. Thank you, my NHD, for making these arrangements, Kathy Lansford and Deborah Comer. They're gonna be training on your iPhone, your iPad, and Mac. So it's a very cool class. Everybody's welcome. So if you bring your Mac, bring your stuff, and please RSVP to Destiny. Lunch is being served, and we want to make sure we have enough for everybody. And then in May, we also have May 17th, May 31st, listing agreement workshop and a purchase agreement workshop. And we do this every couple of months. We just want to make sure you understand that contract forward and backwards, because that will help you in all your negotiations and how to present it to your client as well. Okay, and then Forever Concierge, this program is so exciting. I mean, literally, it just takes your business to the next level. So we are going to be streaming it here Monday, May 15, 17, and 19. You can also register at home by clicking on the email that you'll get from CA Marketing. So make sure you're staying tuned for that, because that's something that every single agent will, it's automatically going to be created for you. So you need to know what you're doing when it comes to it. Okay, Mason just talked to Melda.
Oh, hi. Good morning. If you guys need any help with the VAC, farming, setting up your farms, drip campaigns, neighborhood reports, all that fun stuff, go ahead and book an appointment with me. Sky Slope, I do just basically the basics. Maria is more in depth if you have any questions with that.
And I'll speak for Destiny. She can't speak. So if tickets. If you need to have your computer connected, if you fell off, email Destiny. And if you have mail to pick up, email Destiny. And of course, RSVP again for the lunch on May 9th. Yeah.
One quick thing that you may be getting from me. You know, how many of you received Troy's Monday mindsets and the text that he's sending out on Fridays as well? So the number that it's coming from, that is a group admin number that we can group text to people. I'm contemplating on just special announcements and things. I just need you to know a quick text. I may be using that number to send out a group text, but it'll be the same. In fact, I sent a test one to me and it said maybe Troy. So if you, because that's the one we've been getting that on. So just wanted to give you a heads up. I'm not asking you to do anything. Okay. So again, if you get a text that says, hey, are you busy? Call me. I need a gift card. The answer is no. My text would be, hey, there's something really cool going on in the office here on this day, or I need your feedback, or, you know, RSVP or something like that, but it's never going to ask for any of that. Thank you so much for keeping your head out about the phishing emails, because we are doing really well, knock on wood. We've had 0% failure rate over the last week. Yay. So let's keep that up. That's a big deal. We do have one on Caravan. That's interesting.
Yeah, what is that?
What is that?
Someone wrote on it from the in the sharing, because it's in the share. It's just on the share.
Oh, okay. Let me stop.